Hey guys, today I'll walk you through my top 3 picks for Canadian dividend ETFs. Stick with me to the end as I also tell you what dividend ETFs I have in my portfolio and also some tips for investing in them. The stock market has taken a nosedive, but rather than panic, this could be the best time to invest. I talked about this in my recent video up here about why I keep investing in the stock market even though the market is crashing. Dividend stocks and dividend ETFs can be a great addition to your investment portfolio, especially during downturns. It could take the stock market some time until it recovers, and if you don't have the time to wait it out, investing in dividend ETFs can get you some relatively predictable and regular income. So how did I pick my top 3 dividend ETFs? So to set the stage, these are my criteria. ETFs that contain Canadian companies, so no US companies in this video. Listed in Canadian dollars on the Toronto Stock Exchange. High dividends, well, not necessarily the highest dividends, but high enough to be significant for passive income, or more than 3%, I'd say. Also, all of these ETFs are passively managed ETFs. So these are ETFs that basically just mirror an existing market index, with no fund manager picking stocks. These also all have relatively low MER or management expense ratio. Also positive long-term growth. While growth is not the main focus here, we still want the ETF to appreciate over time. If its value stays flat or even declines, it could offset the dividend gains and reduce your overall returns. And the last criteria, these are all ETFs that invest in equities or stocks. In case you're new to investing, I need to point out here that there are many kinds of ETFs depending on what kind of asset they hold, including cash ETFs, bond ETFs, commodity ETFs, which hold gold, for example, real estate ETFs or REITs, and even crypto ETFs. In this video today, we're only going to talk about stock ETFs. Now, before we get into the top 3 dividend ETF countdown, a quick disclaimer that this is not financial advice. I am not a financial advisor or consultant. This video is for information and entertainment purposes only. So always do your own research before investing any of your money. Now, with that covered, let's start with the countdown. At number 3, we have the XDIV, currently trading at $28.53 at the time of making this video. The XDIV is issued by BlackRock and replicates the performance of the MSCI Canada High Dividend Yield 10% Security Capped Index. So this index basically consists of large and mid-cap Canadian stocks with above average dividend yields and steady or even increasing dividends, which is an important feature to have. The XDIV only has 20 holdings, making it a rather concentrated fund, which basically means the degree to which your investment is affected by a specific asset, sector, region, or market trend. The XDIV has 46.56% exposure to financials, so almost half. It has 31% in energy, also 13% in utilities. Some of the financial companies are Sun Life, TD, Manulife, RBC, each making up 7 to 9% of the holding. So this is the beauty of an ETF. Instead of having to decide which bank's individual stock you want to invest in, you can just buy an ETF that is heavily weighted in financials, that is diversified into different financial institutions, so you are not dependent on the performance of any single institution. And in the energy sector here, you have Enbridge, Fortis, and Suncor Energy, among others. Now next, let's look at the dividend. XDIV has a trailing yield of 4.4% and a distribution yield of 4.76%. Now here's the difference. The trailing yield is a historical yield. So the yield itself tells investors how much return they're getting in cash dividends relative to the price they paid. As an example, if a stock paid you $2 a year in dividends and costs $50 per share, the yield is 2 divided by 50 times 100% equals 4%. It basically tells investors how much return they're getting in cash dividends relative to the price they paid. Now, the distribution yield, on the other hand, is forward-looking. It assumes that the company will continue to pay the most recent dividend into the future. If the recent dividend was high, it could result in a higher distribution yield. In the example of XDIV, it's slightly higher at 4.76%. Which is more important? I think it's a good idea to look at both of these numbers when choosing the best ETF for you to invest in, because the trailing yield gives you an idea of overall consistency of dividend payments of an ETF in the past, while the distribution yield gives you an idea of the dividends you'll likely get paid if you buy that ETF now. And keep in mind that dividend payouts do not always remain the same, but can change depending on the company's profit and management decisions. Next, let's talk about the MER. The XDIV has a beautiful low management expense ratio of just 0.11%. This means that for every $1,000 you invest into this ETF, The fee is just $1 per year, which is negligible. By the way, the MER is not something that you have to pay separately or that's billed to you. The MER is just an annual management fee that is embedded into the fund. But it does reduce your investment return over time, and that's why you want it to be as low as possible. Now, moving on to performance. In the last 5 years, the XDIV returned 18.19% and 10.75% since inception in 2017. This is quite high, especially for a dividend ETF. A nice added bonus, I'd say. By the way, I personally like to look at the past 5 years to see how an ETF has been doing recently. But looking at the all-time number is also very important because it shows long-term growth. Just looking at the 18.19% might be deceiving because we don't know whether or not that growth will continue over the long term. Also, very important when picking an ETF is, of course, your own personal take. How do you think the financial and energy sector in Canada, which the XDIV tracks, will perform going forward? What do you think about the individual companies in the XDIV? And I know it's impossible to predict the future. So if that's too difficult, at least we want to have a solid overview of how our ETFs and other holdings performed in the past. And for this, I've been using an investment app called Wealthsimple for over 4 years now. It has a really great user interface, simple and clear, which makes it super easy to use, especially for beginners. I think it's the perfect place to buy stocks and ETFs, especially because Wealthsimple does not charge any trading fees. It also does not have an account minimum. And if you use my referral code in the descriptions down below and fund your account with at least $1, you'll even get a $25 bonus cash straight into your account. Now, personally, I like to keep my investments on several platforms so I have more flexibility. So even if you already have a broker, consider opening another account with Wealthsimple. It doesn't cost anything. Now on to dividend ETF number 2. The XEI, also issued by BlackRock, currently trades at $24.91. The XEI replicates the performance of the S&P TSX Composite High Dividend Index. I know sometimes these indices names can sound like a word salad, at least to me. So the S&P TSX Composite Index itself, which the XEI fund here mirrors, covers a ton of companies, 75 companies to be exact, from various sectors of the Canadian economy. But not just that, these aren't any companies, but companies that pay a high dividend. Now let's look at what this ETF is exposed to. So the XEI is 30% in financials and almost 29% in energy. Compare that to the previous ETF we talked about, the XDIV, which is almost 50% in financials. Instead, the XEI here has meaningful exposure to other sectors like utilities with almost 15% and to communications with 10%. So this fund provides a bit more diversification. Looking at the companies, the XEI has similar companies like RBC, TD, Suncor, Fortis, but is weighted to a lesser degree in each of these. But what about the dividend yield? The trailing yield is a marvelous 5.79% and the distribution yield 5.24%. This is just lovely. Is it weird to talk about an ETF like that? Anyway, so imagine you had invested $10,000 into the XEI. Even if we use the lower yield, the distribution yield of 5.24%, this means you'll earn $524 per year or $43.67 per month. By the way, this ETF pays dividends monthly and all the other ETFs in this video do as well, but there are other ETFs that pay quarterly. And the best thing, of course, that you can do with those dividends is to reinvest them. Now, there are a couple of ways to do this. You can manually reinvest your dividends. You can also use what's called DRIPs, which stands for Dividend Reinvestment Plan. But if you ask me, DRIP is just a fancy acronym. It just basically means that you automatically reinvest your dividends. So you might just as well use the third method, which you can do on Wealthsimple, the investment platform I mentioned earlier. So here is my TFSA account on Wealthsimple. If you go to settings up here, then go to automations, dividend reinvestments. If you turn this on, all dividends you get in your TFSA will automatically be reinvested into the same asset. Easy peasy. And you can do the same in your RRSP, of course. Now, the XEI's yield is quite strong, but what about the costs? The MER at 0.22% is a bit higher than the previous fund, but still quite competitive. To compare them, take the XDIV trailing yield of 4.4% and subtract the 0.11% MER, and you'll get to a net profit of 4.29%. The XEI here, on the other hand, has a trailing yield of 5.24%, so even at an MER of 0.22%, our net yield is still higher at 5.02%. So that's why it's so important to look at both numbers, not to just be fixated on an MER. Don't be afraid of the MER unless it's ridiculously high, then run. Moving on, how did the XDI perform in the past? The XDI had a very similar 5-year return as the previous fund, the XDIV, at 17.06%. The all-time return since inception in 2011, however, was 7.33%. So yes, it is lower, but the XDI has also been around longer, since 2011, so about 6 years longer than the XDIV. So it kind of has more of a proven track record. So if you're deciding between the XDIV and the XEI, apart from looking at the yields and those other criteria, an important thing to think about, especially when it comes to future performance, is which sectors you think will perform better. If you're bullish on financial companies, you might prefer the XDIV as it's 50% weighted in financials, but if you think financial institutions are going to have a tougher time ahead and you want to be more diversified while possibly cashing in a higher dividend, then XEI is your friend. Unfortunately, no one knows for sure. So these two ETFs are great, but next let's talk about my personal number one. But hold on, some of you might be wondering why I didn't include the XIC. So some people really like the XIC because by buying the XIC, you're practically owning the entire Canadian market. So rather than intentionally weighting higher in financials and energy or higher in high dividend stocks like the XEI we just talked about, the XIC is just investing into everything in the Canadian market. And at first glance, it might sound reasonable, but I am not a fan of all market stocks, and that's not just because the XIC only pays a trailing yield of 2.9%, which is rather low in my opinion. I'll tell you why I'm not a fan. Yes, you'll get even higher diversification by investing into the XIC, but is the highest diversification always best? Is more always better? Now here's something important to remember. Make sure that you never diversify for the sake of diversifying. Why? The point of diversification is that you invest into different assets so you manage your risk. The risk of relying on just one stock or a few stocks' performance and reduce the risk of investing into the wrong stock because there's just something you don't know about the company or the entire sector. Let's take an example of the US market and the S&P 500, which is my favorite index to invest in. If you already know that the S&P 500 has the top 500 companies in the US, and that's over decades and decades, and the index keeps recycling to only contain the top 500 as in the biggest companies, then why would you intentionally invest in the rest of the market that is underperforming compared to these top 500? It sounds like a nice thing to do, to own the entire market, but from a personal financial growth perspective, no for me. Same thing with investing in individual stocks. The only reason we don't invest in an individual stock is that we lack the knowledge or the time to acquire the knowledge about the fundamentals of the company. But if you know something about the particular company, like Warren Buffett, for example, who does thorough research and analysis, then you'd probably want to invest in individual stocks. So going back to the XIC versus other dividend ETFs in this video, I'd personally rather be less diversified but have a higher projected dividend payout because these sectors have proven over long periods of time to deliver high returns. Now let me know what you think in the comments down below. Now finally to our top number one dividend ETF, which is of course the VDY. The VDY issued by Vanguard, not BlackRock again, currently trades at $44.48. Yes, it's more expensive, but it doesn't really matter, especially since many online investment platforms, including Wealthsimple and also Questrade now, offer what's called fractional shares. That's when you can buy less than one share if all you have available to invest at the moment is, let's say, $20. The VDY tracks the FTSE Canada High Dividend Yield Index, and this index basically consists of Canadian companies that pay out high dividends, as the name says. Looking at its holdings, the VDY is 55.5% in financials, so the highest weighting in financials of all the ETFs we talked about. It's weighted 30% in energy and has a mix of other sectors lightly weighted. Looking at the individual companies, VDY is heavily weighted in a few companies like RBC and some other banks, as well as big energy players like Canadian Natural Resources, Enbridge, and Suncor. Granted, the VDY is very concentrated. If you look at the weightings, the top 10 companies represent 70% of the entire portfolio. So if you invest into the VDY, you have to be quite confident in these companies. Yield-wise, the VDY has done very well, with a trailing yield of 4.08% and a distribution yield of 5.27%. Yes, it has gone up recently. That's why we can't just look at the trailing yield. While the trailing yield shows that the VDY has delivered good, consistent payout in the past, the distribution yield shows that it's paying out even more now. Remember, of course, that this is relative to the stock price. So to be fair, the percentage yield may go up and it looks as though you're getting more money, where in fact the dividend payout might have just stayed the same while the stock price has dropped. But that's exactly why I think it's a great time to buy now, as prices are low, at a discount, you can say. The MER is the same as the previous ETF at 0.22%. So if you have $100,000 invested into the VDY, that would mean a $220 expense per year. Now, the interesting thing with the VDY is its performance, which I'd say is not too typical of a dividend ETF. Over the past 5 years, it returned 13.46%. And since inception in 2012, it returned 10%. Now, this is really solid performance over a long time period of 13 years. It just shows that the VDY has potential to continue growing strong in the future while paying out strong dividends. So that proven growth over a long time period is a kind of a bonus, especially if you buy the VDY with the initial intention of just getting paid dividends. But this is actually one important reason why I ranked VDY number 1. Now, that being said, these ETFs are actually very similar in nature, so they are ranked very tightly, I'd say, and you'd be fine with either of these. Which one you ultimately pick will depend on your personal outlook and preference. Do you prefer a more highly concentrated fund like the XDIV, or something like the VDY that is most heavily weighted in financials and has been around for a longer time? And also, don't fret if you don't see your ETF, the ETF that you are invested in right now, in these top 3. It doesn't mean that all other ETFs not on this list are totally useless. You'll be fine if in picking your ETF, you consider the different criteria I mentioned throughout this video. Now, before I reveal my dividend ETF holdings, 2 important tips. Again, not financial advice, but this is just what I do. 1. Don't put all of your money in dividend ETFs. Dividend ETFs should form part of your overall investment strategy. Watch this video on portfolio allocation to find out more. Dividend ETFs are great for you if you want regular payouts and a passive income stream. But there are also growth ETFs. Then there are ETFs covering different asset classes like I mentioned before, covering stocks, bonds, gold as part of commodities, and even Bitcoin. And then there are also US ETFs versus Canadian ETFs and international ETFs, giving you different geographical exposure. So try and rethink what percentage of your portfolio you want to have specifically in dividend ETFs. Another tip, make sure to invest in your registered accounts like the TFSA or RRSP first. You get the benefit of not paying taxes on your capital gains made in these accounts. If you need more information about the TFSA, click on this video here. Now to the reveal. Which dividend ETFs do I hold in my portfolio? Currently, none. I don't have any dividend ETFs in my portfolio anymore. Now, when I started investing in Canada, I invested in VDY, so it was truly my top choice. At that time, I was a beginner and wanted to invest in something that felt safe. But since then, I learned and changed. I decided that yes, at a later point in time, I will buy dividend ETFs again, but likely closer to retirement. Before that, while I'm still young, I am prepared to take on higher risk and enjoy higher reward as well. And I do that mainly by investing in growth ETFs. I have a video on my favorite ones here as well as investing in Bitcoin. And I know that Bitcoin is still a bit controversial, but if you're not invested in Bitcoin, you will regret it. Again, not financial advice. In case you're interested to know what I think about Bitcoin and why you should consider it, then watch this video next.